What if I told you that this past week's market chaos isn't really about stocks at all? That we just witnessed the first major crack in what might be the most dangerous financial house of cards built in the last decade? Because while everyone's focused on the Dow's wild swings and Bitcoin's nosedive, they're missing the real story here. Three seemingly separate headlines dropped past week that, when you connect the dots, reveal something Wall Street desperately doesn't want you to see. And it's not just about your portfolio. It's about how fragile our entire financial system has become when digital assets can trigger old school market panics. Let me break this down for you, because the mainstream coverage is completely missing the point. First, we had Bitcoin absolutely crater this week, dragging the entire crypto market down with it. Then, almost simultaneously, we saw one of the most violent stock market reversals in months. Finally, by Friday, we got this weird artificial looking bounce that had strategists openly admitting it was built on nothing solid. Here's what really happened and why it should terrify anyone with money in the markets. The Bitcoin connection isn't just correlation, it's causation. And it's revealing a hidden web of leverage that makes 2008 look quaint. Think about this for a second. We're being told that Bitcoin, which represents maybe 1% of global financial assets, somehow has the power to trigger massive stock sell-offs. That doesn't happen unless there are serious structural problems we're not being told about. Here's the reality. Institutional investors have been using Bitcoin and other crypto assets as collateral for traditional stock purchases on a scale nobody wants to admit. When Bitcoin started tanking, it triggered margin calls that forced massive stock liquidations. This isn't just some retail investors panic selling their Robinhood accounts. This is sophisticated money getting caught in a liquidity trap. The numbers tell the story. We saw billions in stock sales happen almost instantly after Bitcoin broke key support levels. Almost instantly after Bitcoin broke key support levels. That's not coincidence. That's algorithm deleveraging. The same computerized trading systems that were supposed to make markets more efficient are now creating cascading failures across completely different asset classes. But here's where it gets really interesting. The financial media is treating this like it's some new phenomenon, but it's not. What we're seeing is the natural evolution of a system where everything has become collateral for everything else. Your crypto holdings back your stock positions, back your real estate investments. Your real estate backs your crypto purchases. It's leverage all the way down. And the regulators, they're completely blind to it because it's happening in the shadows of decentralized finance and offshore exchanges that don't report to anyone. Now, about that Friday bounce that everyone's celebrating. This is where the story gets really concerning. Market strategists are openly saying this recovery was built on something very ephemeral. Translation, it's fake. It's not based on improved fundamentals, better earnings, or even genuine Fed policy expectations. It's based on hope and algorithm buying that kicked in after the sell-off reached certain technical levels. This is what happens when the markets become dominated by machines instead of human judgment. You get these violent swings in both directions that have nothing to do with the actual economic reality. The same algorithms that sold everything on Tuesday bought it all back on Friday. Not because anything fundamentally changed, but because the price hit predetermined levels. The Fed rate cut narrative is just convenient cover. Everyone knows the Fed is trapped between inflation concerns and market stability. They can cut rates significantly without risking another inflation spike. But they can't raise them without triggering more market chaos. So we get this perpetual dance of maybe they will, maybe they won't, that provides cover for algorithm trading strategies. Here's what's really happening. We've created a financial system where confidence is literally the only thing holding everything together. Not underlying value, not economic fundamentals, not even traditional risk management, just confidence. And when that confidence cracks everything even slightly, the whole thing starts to unravel. The Bitcoin crash revealed that confidence is evaporating faster than anyone wants to admit. When digital assets that were supposed to be uncorrelated with traditional markets start driving traditional market behavior, it means the correlation is 100% just in the worst possible way. This brings us to the bigger picture that nobody's talking about. We're not just looking at a market volatility. We're looking at the early stages of a complete breakdown in how financial markets are supposed to work. When crypto speculation can trigger margin calls that force stock sales that create artificial bounces based on algorithm buying, you don't have a market anymore. You have a casino where the house doesn't even know what game is being played. The companies everyone's watching, Nvidia, Apple, Eli Lilly, their actual business fundamentals haven't changed significantly this past week. But their stock prices swung widely because of Bitcoin liquidations and algorithm trading. That should scare the hell out of anyone who thinks they're investing based on company performance. What we're witnessing is the financialization of everything reaching its logical conclusion. Every asset class is now connected to every other asset class through layers of leverage, derivatives, and algorithm trading that create systemic risks nobody fully understands. The traditional investment advice of diversification is meaningless when everything moves together. The old rules about crypto being a hedge against traditional markets are dead. The belief that stock markets reflect economic fundamentals is a fairy tale. So, where does this leave us? We're heading into a period where market movements will become increasingly divorced from economic reality, where a single asset class can trigger cascading failures across the entire financial system, where confidence becomes the only currency that matters. And confidence is the most volatile commodity of all. The smart money isn't asking whether this will happen again. They're asking when and how much worse it will be next time. Because this past week's crash wasn't a correction, it was a stress test. And we failed. Here's my prediction. Within next 6 months, we're going to see another event like this, but bigger. The leverage hasn't been unwound. The systemic risks haven't been addressed. And the algorithm trading systems are still running the same strategies that created this mess. The question isn't whether our financial system can handle another shock like this. The question is whether it can handle the shock of people realizing how fragile it really is. So tell me, are you still comfortable with your investment strategy in a world where Bitcoin can crash your stock portfolio? Because that's the world we're living in now, whether we want to admit it or not. Don't forget to like this video, subscribe, and hit that bell button. I'll see you next time. Bye bye.